All right, let's get right into it. There's this incredibly fine, almost invisible line that the IRS draws between crypto trading and crypto gambling. And look, it might sound like some boring academic distinction, but I'm telling you, getting this wrong is one of the fastest ways to trigger a really painful forensic-level audit. So today, we're going to dissect exactly where that line is, why the IRS is so obsessed with it, and how making the wrong call can literally make your financial losses just disappear for tax purposes.
So here's our game plan. First, we're going to look at why this line is getting so fuzzy to begin with. Then, we need to build a solid foundation. We have to understand how the tax code treats losses in general before we get into the weird stuff. From there, we'll put the specific wagering loss rule right under the microscope, see its pretty devastating real-world consequences, and then we'll flip the coin and look at the strategies that are only available to traders. And finally, we'll pull back the curtain on the red flags the IRS is actively hunting for right now.
Okay, Section 1, the blurring line. You know, with the explosion of DeFi, all the gamified tokenomics, and these decentralized online casinos, the actual difference between making a trade and placing a bet, well, it's getting harder and harder to tell them apart, isn't it? The root of the problem is that the entire tax treatment for crypto is based on the IRS calling it property. That's a concept from like the 1920s that's now being force-fitted onto this brand new digital world, and it just doesn't quite work.
And that really brings us to the core question of this whole deep dive. The IRS is basically forcing you to pick a side and be ready to defend it. And believe me, the stakes could not be higher. This is not about word games. It's about whether the very real financial losses you took are even recognized by the tax code, or if they just poof, vanish into thin air.
So, let's move on to our second section and build this out. The Bedrock of Loss. Because look, before we can really appreciate just how uniquely punishing the gambling rules are, we first have to understand the basic principles of how any economic loss gets treated under the Internal Revenue Code.
Now, this is absolutely fundamental. It's the core doctrine of a closed and completed transaction, and it's written right into Treasury Regulation section 1.165-1. What it means is this. If your crypto portfolio crashes by 99%, you cannot claim a tax loss, not a penny. That loss is what's called unrealized. To make it real in the eyes of the IRS, you have to have an identifiable event. You got to sell it, exchange it, liquidate it, something that proves without a doubt that the loss is permanent and it's final.
And this just shows you how different types of losses get completely different treatments. For a theft, Treasury Regulation 1.165-8 says the burden is 100% on you to prove it was a crime and that there's zero chance of getting it back. For an exchange bankruptcy like FTX, if you qualify for non-business bad debt treatment under IRC Section 166D, it's automatically treated as a short-term capital loss. That's it. But here is the absolute crucial point for every single person holding crypto. That really helpful worthless securities rule under Section 165G, it does not apply. The IRS is crystal clear on this. Crypto is property, not a security.
Which brings us right to the heart of the matter in Section 3, the wagering loss limitation. We are now going to do a forensic analysis of Internal Revenue Code Section 165D. This is the one statute that creates these two totally separate financial universes we're talking about.
And there it is. That's the exact language from the code. It is direct, it is absolute, and it is completely unforgiving. You know, with normal businesses or investments, your expenses are pretty broadly deductible against income. But here, Congress used this power they have called legislative grace to build a giant wall, completely sealing off your wagering losses from the rest of your financial life. And here is the brutal, real-world result of that one sentence. If you're a trader, your capital loss can offset your capital gains, plus you can deduct up to $3,000 a year against your ordinary income like your salary. And any leftover losses? They carry forward to future years, forever. Now what about the gambler's wagering loss? It can only offset wagering gains from that exact same year. That's it. You get zero deduction against your salary or other investment gains. And any excess losses are just gone, forever. They just evaporate. Let's make this painfully clear. Let's say you have $200,000 in wins from various bets throughout the year, but you also have $250,000 in losses. In economic reality, you're down 50 grand. But for tax purposes, that $50,000 loss provides you with zero tax benefit. It's just gone. You cannot carry it forward. From the IRS's point of view, it might as well have never happened. And oh, it gets worse. The Tax Cuts and Jobs Act of 2017 came along and specifically reversed a taxpayer-friendly court decision, a case called Mayo versus Commissioner. It actually expanded the definition of losses from wagering transactions to include every single related expense. So for a professional, we're talking data subscriptions, software, computers, travel. All of it gets thrown into that same wagering loss bucket, and it's all strictly limited by your gross winnings.
Okay, let's shift gears into Section 4 and look at the real-world consequences of these rules. This is where the abstract theory of the tax code really hits your bank account, and it can hit it hard.
Now this right here is probably the single most dangerous trap for anyone using crypto in these ecosystems, the dual event taxation trap. So when you use appreciated crypto, let's say some Ethereum you bought a while ago, to place a bet, the IRS sees two completely separate taxable events. First, just the act of placing the bet is considered a disposition of property, which triggers a capital gain. Then, second, if you actually win the bet, that's taxed separately as ordinary gambling income. It's insane. You can literally owe a ton of tax just for making a bet before you even know if you've won or lost.
And then you've got this really insidious phantom income problem. See, for a recreational player, your wagering losses are an itemized deduction. But ever since the TCJA jacked up the standard deduction, most people don't itemize anymore. So this creates a nightmare scenario where you could win $10,000 and lose $10,000, your net is zero, but you'll end up paying tax on the full 10 grand of gross winnings because you get absolutely no benefit from that loss deduction.
So you're thinking, fine, I'll just declare myself a professional to get around this. Well, not so fast. The Supreme Court set an incredibly high bar in a famous case called Groitzinger. You have to prove this isn't a hobby but a full-time regular business activity that's intended to be your livelihood. And the IRS loves to use the hobby loss rules in IRC Section 183 to aggressively challenge this status, especially if you have another job.
So with all that pain and misery on the gambling side, let's pivot and look at the other world in Section 5. Let's talk about the powerful strategic advantages that are available but only to those who are properly classified as traders.
The single biggest advantage, by far, is that the wash sale rule does not apply. For stocks, IRS Section 1091 stops you from claiming a loss if you sell a stock and then buy it right back within 30 days. But because the IRS classifies crypto as property, not a security, that rule is off the table. This means you can legally sell your crypto to realize a loss, which offsets other gains, and then buy it back 1 minute later. It's called tax loss harvesting, and it can create a huge tax benefit.
Traders also get to use strategic accounting methods. The IRS default is FIFO, or first in, first out, which can trigger massive gains if you bought early. But you can choose to use a method called specific identification. This lets you handpick the exact coins you're selling. So for instance, you can sell those high-cost basis points you bought at the peak to maximize your tax loss. But here's the catch, and it's a big one. You must have immaculate contemporaneous records to prove it. This is absolutely non-negotiable if you get audited. Okay, this brings us to our final section, the IRS Audit Calculus. Now that we know all the rules of the game, let's look at how the IRS actually flags returns for a closer look.
The IRS is not just guessing, it's all about the data. Their computer systems automatically flag any mismatch between the Form 1099s and W-2Gs they get from exchanges and what you actually report on your return. Checking no on that big crypto question right on the front page of the 1040, that's a huge red flag for willful concealment. Offshore accounts get cross-referenced with your FBAR and FATCA filings. Even something as simple as using round numbers on your return screams to an auditor that you don't have good records. And now they're deploying AI to specifically target high-volume, complex returns for a much, much deeper look.
So here's the bottom line. The lines between trading and gambling might be blurry out there in the real world of DeFi, but on a tax return, they are black and white. So your crypto activity, are you an investor or are you a gambler? The financial consequences of that choice are absolutely immense, and the IRS is forcing you to make it and be ready to defend it.